Canada's inflation or CPI data for October is due next Tuesday, and that headline inflation rate has made some progress. You'll recall that the latest read we got for September came in at 3.8%, the annualized rate. Compare that to 6.9% a year earlier in September of 2022. Well, a new report from the Howe Institute says most of the decline has been driven by falling energy prices, while most of the remaining inflation is being caused by supply side factors such as pricing, production costs, and supply chain issues. What could this mean for the Bank of Canada's rate roadmap? Joining us now is a co-author of the Howe report. Trevor Tombe is a professor of economics at the University of Calgary and joins us now. Thanks so much for your time this afternoon, Trevor.
Great to be here. Thanks for having me on.
So I mentioned some of the supply side factors that you're looking at or pointing to as still being real forces in Canada's inflation rate at this point. What can be done about those factors? I mean, I almost feel like we're at the beginning of the pandemic when you're talking about supply chain issues and talking about the Bank of Canada starting to raise rates. And it's like, well, what are they going to be doing to help? How does that impact, or improve the supply chain situation? So, what sort of issues or pressures that persist right now can the Bank of Canada have an influence over?
Well, it is important to distinguish between demand-driven price changes and supply-driven price changes. As you noted, the Bank of Canada controls interest rates, and that affects largely the demand, both of consumers, but also of businesses making investment decisions. When the price of something increases because people are demanding more of that item, it's a little bit easier and less costly for the bank to lean against that kind of pressure. But when it's a supply-driven price change, this could be, as you noted, pricing strategies, but anything around production costs, energy costs being an important one, or other global developments, that's harder for the bank to offset because it tends to come with far lower levels of economic activity than if the price increase was driven by a demand side factor. So it's not like the bank is powerless here. It's just that it's more costly for them to offset these supply-driven factors that we're seeing now largely dominate the inflation picture in Canada.
So it has to do more in order to have the effect that it wants to have if it's targeting the supply side versus the demand side?
Well, think about a price increase that's due to consumers demanding more of it. If we go out there and spend more on a particular item or goods and services across the board, then both price and quantity will increase. And so that's an upward increase in prices that's associated with more economic activity. And so for the bank to raise interest rates and pull that demand back can be a way to not just lower prices or the pace of price growth, but also bring the level of activity back to a normal, more sustainable level. But if a price change is driven by a supply side factor, then that'll have a price increase and a reduction in overall economic activity. And so the bank, to offset that price increase, as it should, to be clear, that would come with even more of a reduction in economic activity. So there is just a difference in the cost of action, but the bank is still mandated to achieve a 2% inflation goal over the long haul, regardless of what the underlying source of that price pressure is.
If you were a business feeling the pressure from a supplier to, pay them more and then needing to pass that on to consumers, wouldn't you be making that calculation as well if you had to raise prices and the demand wasn't going to be there? Then you wouldn't be able to raise prices as much as you might want to, right? So wouldn't it sort of balance out if the demand isn't there?
Well, so the demand is there in the sense that if you're a producer that needs to charge more for an item, you may very well sell less, or some of your competitors may be strained. So economic activity in the sector would shrink in response to that price increase. But depending on the level of competition that you see in that market, your profit margins might already be fairly low and not a lot of room to absorb an input cost change. And so you'd have no choice but to increase prices. And we do see that in lots of markets. I think about one of the big drivers of food price changes is the cost of producing food on the farm. So agricultural product price indexes are a very strong leading indicator of food price changes. And so we see when input costs rise, so too do prices that are charged by producers, and therefore prices that consumers face as well. So I don't see this as a question around whether cost increases are unable to be passed through or not. I see it as more of a macro question where it's important to understand why the pace of price growth is still high, despite interest rate increases that we've seen over the past year and a half. So one thing we measure in the paper is that the increase in interest rates that we've seen has had the desired effect. We've seen a drop off to near zero now in the demand side price pressures among goods and services that are sensitive to interest rates. But unfortunately, that's been offset by an increase in supply-driven price increases for those same goods. So maybe that's temporary. I think time will tell. But if these supply-side pressures persist, then the bank may need to either raise rates further or keep their current high rate in place for longer.
I mean, that's interesting because there's also a lot of talk right now about when the Bank of Canada might start cutting rather than whether the Bank of Canada is going to keep raising rates, even though we know that the central bank has left that possibility on the table and has been clear that it would go ahead and raise interest rates further if it felt that was necessary. But you're talking about the possibility that rates might have to go higher. Do you think that could be the case?
So I think time will tell how persistent what we're measuring as additional supply side price pressures remain in place. I think on the one hand, some of it may dissipate. Energy has come down a lot. That's accounted for just over half the drop in Canada's inflation compared to June of last year. And it does take time for drops in energy prices to affect consumer prices. I mentioned agriculture. There's about a 6-month lag between agriculture input costs and producer prices changing and consumer prices. So we may see some dissipation of these supply side factors, but the bank has a tough job. They need to think about a year and a half, 2 years down the line. So they're not reacting to the data today so much as where they think the data is going to be at the end of next year or into 2025. And there is one important supply side factor or potential factor that we took a look at that some are raising or have raised concerns about, and that's whether there's wage-induced inflation. So we've seen the pace of wage growth increase, and so we took a look at that. That would have been a supply side factor, but we don't measure any important relationship between the pace of price growth, the supply-driven price growth by goods and services, depending on their labor intensity. And if wage was important, or wage increases were important, we'd expect price pressures to be largest among labor-intensive goods and services. And we just don't see that. And so that's a potential sign of hope. To the extent that people's inflation expectations remain anchored, then the bank will have an easier time if these other supply-side shocks are just temporary.
Trevor